When we look at the global economy in 2025, we have to start by understanding that what's happening today is not random. It's part of a much larger cycle that has repeated throughout history. Every economy, every empire, every currency follows a set of predictable patterns driven by human behavior, debt accumulation, productivity, and the shifting balance of power. The current economic environment, characterized by high debt, elevated inflation, and geopolitical tension, is the natural consequence of forces that have been building for decades. To understand where we are going, we must first understand the machinery of how the economy works. The global economy runs in long-term debt cycles, typically lasting around 75 to 100 years. These cycles begin when debt levels are low and productivity is rising. Borrowing stimulates growth. Asset prices increase and confidence expands. Over time, however, debt grows faster than income, and eventually, the system reaches a point where the obligations become unsustainable. When the ability to service debt declines, policymakers step in, using monetary easing or fiscal spending to delay the correction. This buys time but doesn't solve the structural imbalance. It simply shifts the pain into the future. In the last decade, we've seen this exact process unfold on a global scale. Since the 2008 financial crisis, central banks have printed enormous amounts of money to keep economies stable. Interest rates were pushed down to near zero and, in some cases, negative to stimulate borrowing and spending. This created what appeared to be prosperity, but much of it was built on credit expansion rather than real productivity growth. The pandemic in 2020 accelerated this process dramatically. Governments injected trillions of dollars into the system, expanding debt faster than any period in history. Those policies prevented a collapse, but they also inflated asset prices, increased inequality, and devalued currencies. What we're seeing in 2025 is the late stage of that long-term debt cycle, where high debt, slowing productivity, and political division all converge. When a society reaches this stage, the economic machine behaves differently. The tools that used to work, lowering interest rates or increasing government spending, begin to lose their effectiveness. Inflation becomes harder to control because the system is saturated with liquidity, and at the same time, the real economy struggles to produce enough growth to support the rising debt burden. We can see this tension everywhere, from the United States and Europe to China and Japan. Central banks are walking a narrow path, trying to contain inflation without triggering a deep recession. But history shows that balancing this equation is almost impossible. At some point, the markets force a deleveraging, a painful but necessary process that brings debt and income back into alignment. One of the most important structural forces shaping today's economy is the imbalance between productivity and debt. True economic growth comes from increases in productivity, the ability to produce more goods and services per unit of labor and capital. Debt, on the other hand, only pulls future spending into the present. When borrowing outpaces productivity, the system becomes fragile. Over the past 2 decades, productivity growth has been sluggish across most developed economies, while debt has continued to expand. This means that a growing share of global wealth is paper wealth, financial assets whose value depends on liquidity and confidence rather than underlying production. This is why markets have become more volatile and why wealth gaps have widened dramatically. Another structural shift is demographic. Many developed nations are aging rapidly, with fewer young people entering the workforce and more retirees drawing on public resources. This dynamic puts additional pressure on government budgets, pension systems, and healthcare costs, forcing policymakers to choose between higher taxes, more debt, or inflation. Emerging markets, by contrast, have younger populations and are becoming the new centers of labor, consumption, and innovation. This demographic divergence is reshaping the flow of capital and trade across the world. Investors, companies, and governments are all repositioning themselves to benefit from this shift, moving supply chains, reallocating investments, and adjusting their geopolitical alliances. The third major force at play is technological change. Automation, artificial intelligence, and digital finance are transforming how economies function. Technology can boost productivity, but it also disrupts labor markets, displaces workers, and concentrates wealth in fewer hands. Historically, such technological revolutions create short-term dislocation but long-term progress. However, when they coincide with high inequality and political polarization, as they do now, the transition can become unstable. This instability leads to populist movements, social unrest, and the breakdown of trust in institutions. In other words, economic cycles and social cycles are intertwined, and both are now approaching critical inflection points. When multiple structural forces, debt, productivity, demographics, technology, converge, they tend to amplify one another. The result is a period of great change and often great uncertainty. That's where we are in 2025. The global economy is not collapsing, but it is transforming. We are moving from an era of easy money and globalization toward one defined by capital scarcity, regional competition, and greater government intervention. This is not a crisis in the moral sense. It is simply the next phase of the long-term cycle. But as with all transitions, it requires adaptation. If we look back through history, similar transitions occurred in the 1930s and 1970s, both periods marked by high debt inflation and shifting global power structures. In each case, the world eventually reset through monetary reform, redistribution, and the rebalancing of global influence. Today's environment has many of the same ingredients. The question is not whether change will happen, but how smoothly it can occur. The nations and individuals who understand the mechanics of this shift will emerge stronger. Those who ignore it will struggle. At the national level, this means building resilience through balanced budgets, productive investment, and cooperation rather than confrontation. At the individual level, it means diversifying income sources, holding assets that preserve value during inflationary periods, and continually investing in one's own skills and adaptability. The most dangerous mistake people make during these transitions is assuming that the future will resemble the past. But cycles always change, and what worked in one era often fails in the next. In short, navigating today's economy begins with recognizing that the challenges we face are not new, they are recurring patterns. Debt accumulation, monetary expansion, and political realignment have happened many times before. The key is to look beyond the noise of daily headlines and study the cause and affect relationships that drive these outcomes. Once we understand those mechanics, we can make better decisions as investors, as citizens, and as societies. The story of 2025 is not one of collapse, but of transformation. The old system, built on cheap money and global integration, is giving way to a new one that demands discipline, diversification, and deeper understanding. Those who can see the patterns and adapt accordingly will not just survive, they will thrive in the decades to come. Inflation is not simply the rise in prices that we see at the grocery store or in housing markets. It is the direct consequence of how money, credit, and debt interact within an economy. When you understand that money is just a claim on goods, services, and assets, then inflation is what happens when those claims grow faster than the real things they represent. Over the last several years, governments and central banks have been forced to print extraordinary amounts of money to manage crises. First in 2008, then again during the pandemic, and once more to offset slowing growth and political pressure. By 2025, we are living with the long-term effects of those decisions. The system is saturated with liquidity, and while that liquidity temporarily created wealth on paper, it also diluted the real value of money itself. When debt levels rise beyond sustainable limits, central banks face a choice: allow defaults and economic pain, or create new money to ease the burden. Almost always, they choose the latter. This process, called monetization of debt, reduces the real value of what is owed by inflating it away. But that comes with a cost. It erodes the purchasing power of everyone holding that currency. Historically, inflation becomes the quiet form of default. Instead of saying, "We can't pay," governments print money to make payment easier, but what is repaid is worth less. In the short run, this approach feels less painful, but over time it transfers wealth from savers to borrowers, from the cautious to the leveraged, and from the lower income class to those who own real assets. In 2025, inflation remains one of the defining forces shaping economic behavior across the world. Even as central banks have raised interest rates, the underlying structural inflation, driven by deglobalization, energy transitions, and persistent fiscal deficits, continues to linger. Many people misunderstand inflation as something that can be easily controlled by tightening monetary policy. But once a society becomes used to high spending, cheap credit, and constant government support, cutting that flow becomes politically and socially difficult. The system has been built to depend on easy money. Tightening it too much risks breaking parts of the economy. Keeping it too loose risks further inflation. It's a dilemma that policymakers have faced in every late-stage debt cycle throughout history. The U.S., for instance, is running large budget deficits even in times of economic stability. Debt as a percentage of GDP has reached levels not seen since World War II. When interest rates rise, the cost of servicing that debt increases dramatically. This forces governments to either raise taxes, cut spending, or issue even more debt, all of which have political consequences. The result is a constant balancing act between fiscal responsibility and political survival. To fund these deficits, central banks often end up being the buyer of last resort, creating more currency to absorb the excess debt. That process expands the money supply, and once that money enters circulation, it begins to chase the limited supply of goods, services, and assets, creating inflationary pressure that is difficult to reverse. What many investors and ordinary citizens are realizing is that the very definition of money is changing. For decades, people believed that holding cash or bonds was a safe way to preserve wealth. But in an inflationary world, cash becomes a wasting asset. When the real return on savings is negative, meaning inflation outpaces interest rates, money silently loses value every year. This realization is forcing a shift in thinking about what constitutes a true store of value. Historically, societies have turned to tangible or scarce assets during periods of monetary debasement, such as gold, land, commodities, and more recently, certain digital assets like Bitcoin. The reason is psychological as much as economic. People want something that governments cannot print. However, not all stores of value are created equal. Their effectiveness depends on trust, liquidity, and scarcity. Gold, for instance, has served this role for thousands of years because it is scarce, durable, and universally recognized. Real estate provides utility and long-term appreciation, but it is less liquid and more vulnerable to local cycles. Equities, on the other hand, can outpace inflation if they represent productive companies that grow earnings faster than prices rise. The challenge for investors in 2025 is to balance these different assets intelligently, recognizing that no single class is immune to volatility or policy intervention. Another dynamic shaping inflation today is the geopolitical shift toward protectionism and regionalization. For decades, globalization kept inflation low by allowing goods to be produced wherever it was cheapest. That era is fading. Trade wars, security concerns, and supply chain disruptions are leading nations to prioritize resilience over efficiency. Reshoring and friendshoring policies, while strategically sound, increase production costs. Energy transitions, such as the move toward renewable power and electrification, also require massive capital investment. These forces collectively create what economists call structural inflation, a type of inflation that persists because it's built into the cost structure of the economy itself. At the same time, the social and political environment is adding new layers of inflationary pressure. In many countries, there is rising demand for higher wages, expanded social programs, and public investment in infrastructure and defense. These demands are understandable. They address inequality and security concerns, but they require financing. Without equivalent increases in productivity or taxation, that financing comes from more debt and eventually more money creation. The political incentive to spend remains stronger than the incentive to save. This is why inflation, even if temporarily subdued, tends to reappear in cycles. For individuals trying to navigate this environment, the key is education and adaptability. Understanding how inflation erodes purchasing power helps people make smarter financial decisions. For instance, keeping all wealth in cash or fixed income is a poor strategy in such times. Instead, it's essential to hold a mix of assets that can either grow with or outpace inflation. Diversification across currencies, asset classes, and geographies becomes crucial. This doesn't mean speculative behavior. It means strategic positioning, protecting oneself from the silent tax that inflation imposes. From a societal perspective, inflation tests trust in currency, in government, and in institutions. When people lose faith in money's ability to hold value, they start seeking alternatives, which can lead to financial fragmentation and instability. That's why the credibility of central banks is so critical. Managing inflation isn't just about raising or lowering interest rates. It's about maintaining confidence that the value of money will be preserved over time. Once that confidence breaks, restoring it becomes extremely difficult, as seen in historical cases like Weimar Germany, Latin America in the 1980s, or even more recently, countries facing runaway debt monetization. Inflation, in the end, is both an economic and a moral phenomenon. It rewards debtors and punishes savers, encourages short-term consumption over long-term planning, and shifts incentives across society. When managed well, moderate inflation can stimulate growth and innovation. When mismanaged, it can erode the foundation of an economy, the social contract built on fairness and stability. As we move through 2025 and beyond, the lesson is clear: inflation is not a temporary nuisance. It is a reflection of how we manage money, debt, and discipline. The world has entered a new era where printing money to solve every problem is no longer sustainable. The question is not whether inflation will vanish. It won't. But how societies will adapt to living with it. Those who understand its roots prepare accordingly and anchor their decisions in historical patterns will not only protect their wealth, but also help build a more stable economic future. We are living in one of the most significant geopolitical and economic transitions of our lifetime. The shift from a unipolar world dominated by one superpower, primarily the United States, to a multipolar order where multiple nations, most notably China and other emerging economies, are competing for influence. This change is not sudden. It is the culmination of long-term cycles that have repeated throughout history. Every empire and leading economy eventually reaches a point where its financial, political, and military dominance declines, giving rise to others that are stronger, more productive, or more disciplined. What we are witnessing in 2025 is not the end of globalization, but the restructuring of it from a system centered on one global hub to a network of regional powers with their own spheres of influence. To understand this transition, we must look at how power has historically moved between nations. The key drivers of global dominance are productivity, competitiveness, innovation, education, and financial strength. These elements create economic prosperity, which funds military power and global influence. Over time, however, the very success of a dominant power tends to sow the seeds of its decline. High living standards and long periods of peace often lead to rising debt, internal conflict, and declining work ethic, while emerging rivals become more disciplined and focused on growth. This cycle is evident throughout history, from the Dutch and British empires to the rise of the United States, and now the growing strength of China and other emerging markets. After World War II, the U.S. established a global order built around the dollar, open markets, and liberal democracy. This system brought unprecedented prosperity and stability, but it also created imbalances. The U.S. dollar became the world's reserve currency, giving America a unique advantage. It could borrow and print money to finance its deficits because the rest of the world needed its currency. However, over time, that privilege encouraged overconsumption and underproduction. The U.S. shifted from being the world's largest creditor nation to its largest debtor. Manufacturing declined, debt grew, and wealth inequality expanded. Meanwhile, other nations learned, adapted, and built their own competitive strengths. China, in particular, followed a strategic path of long-term development, investing in education, infrastructure, and technology while maintaining a disciplined approach to savings and production. Its rise has not only been economic, but also geopolitical. By 2025, China's economy rivals that of the United States in size, and its influence in Asia, Africa, and parts of Europe has expanded through trade, investment, and diplomacy. Alongside China, other nations like India, Indonesia, Brazil, and those in the Middle East are becoming increasingly important players. This diffusion of power is what defines the new multipolar world. Instead of one global leader setting the rules, we now have several regional powers pursuing their own models of governance, economics, and alliances. This shift has profound implications for global capital flows. In the unipolar era, capital moved easily across borders, and most of it flowed toward U.S. markets because they were perceived as the safest and most liquid. The dollar's dominance made it the default choice for trade, savings, and investment. But as geopolitical tensions rise and trust in U.S. fiscal discipline erodes, many countries are seeking alternatives. Central banks are diversifying their reserves away from the dollar, increasing holdings in gold, commodities, and other currencies such as the yuan. Trade agreements between major economies are increasingly being settled in local currencies rather than dollars. This trend does not mean the dollar will disappear as the global reserve currency anytime soon, but it does mean its dominance is gradually being diluted. When multiple powers compete economically and militarily, global systems become more fragmented. Supply chains are reorganized not just for efficiency, but for security. The U.S. and its allies are reshoring or friend-shoring critical industries such as semiconductors, energy, and defense manufacturing. China, on the other hand, is building resilience through domestic innovation and partnerships across Asia and Africa. This decoupling process adds cost and complexity to global trade, contributing to the inflationary pressures we see today. Yet, it also opens opportunities for smaller nations and regional blocs to assert themselves as independent centers of growth. The multipolar world also brings shifts in technological leadership. The race for dominance in artificial intelligence, quantum computing, and green energy has become the new form of competition. Innovation is no longer concentrated in Silicon Valley or Western Europe. It's now spread across Shenzhen, Bangalore, Singapore, and Seoul. This dispersion of innovation accelerates global progress, but also creates new tensions, as each power seeks to protect its intellectual property and control strategic industries. Just as the 20th century was defined by control over oil and manufacturing, the 21st century will be defined by control over data, algorithms, and energy technologies. From a macroeconomic perspective, these shifts affect investors, businesses, and policymakers alike. In a unipolar world, the rules were relatively clear. Invest where markets are stable, currencies are strong, and governance is predictable. In a multipolar world, uncertainty is higher. Capital must now navigate different regulatory environments, political risks, and cultural expectations. However, for those who understand these dynamics, the diversification of global power creates opportunity. Investing in emerging markets with growing productivity, young populations, and technological innovation can yield significant returns over time. The challenge lies in distinguishing between sustainable growth and speculative bubbles, between nations that are truly becoming more productive and those relying on short-term capital inflows. Another aspect of this shift is the ideological divergence in economic models. The Western world tends to favor open markets, individualism, and private enterprise. Many emerging economies, especially in Asia, favor state-guided capitalism, where governments play an active role in directing investment and strategic industries. This difference in models creates tension, but it also sparks innovation in governance. We are entering a period where multiple systems will coexist, and the competition between them will determine which approaches lead to the most sustainable prosperity. History shows that transitions between world orders are rarely smooth. The last major one, from the British to the American order in the early 20th century, involved 2 world wars and a global depression. The hope is that this time the transition can be more peaceful and cooperative. But tensions over trade, technology, territory, and ideology are real and growing. The U.S.-China relationship will define much of the global economic landscape in the coming decade. Both nations are interdependent, economically tied through trade and investment, yet strategically competitive. Managing that balance will require wisdom, restraint, and mutual understanding. For individuals and investors, the lesson is to think globally but act prudently. Diversifying across countries, currencies, and asset classes is more important than ever. Holding exposure only in one region or relying on a single currency is risky in a world where power and money are in motion. The multipolar order rewards those who study history, recognize cycles, and adapt early. It also demands humility, the understanding that no empire, no currency, and no institution remains dominant forever. In essence, the shift from a unipolar to a multipolar world is not the end of progress, but the redistribution of it. Innovation, wealth, and influence are spreading more widely, creating a more complex but potentially more balanced global system. The challenge for policymakers, investors, and citizens is to adapt to this new reality, to understand that stability will no longer come from a single center of power, but from cooperation, diversification, and a deep understanding of how interdependence shapes our shared future. If you study history closely, you begin to see that the world operates through repeating patterns. The details change, the technology, the names, the borders, but the underlying human behaviors and economic mechanics remain remarkably consistent. Debt rises, empires expand, Currencies debase, social tensions grow, and eventually, systems reset. What determines whether a person, an institution, or a nation survives these transitions is not how strong they appear in moments of stability, but how adaptable they are when everything begins to change. In 2025, we are in such a transition, a period of profound transformation in global economics, technology, and geopolitics, and adaptability, diversification, and historical understanding are the keys to navigating it successfully. Adaptability begins with humility. The recognition that the world is constantly evolving and that no one, no matter how experienced, can predict the future with precision. Most people make the mistake of assuming that the future will resemble the past, that what worked yesterday will work tomorrow. But history tells a different story. Every major economic shift, from the Great Depression to the stagflation of the 1970s to the rise of digital globalization, caught most people unprepared because they clung to old assumptions. The first step to thriving in a changing world is to accept that change is inevitable, to question existing beliefs, and to constantly update one's understanding based on new realities. Adaptability also means being mentally and emotionally prepared for volatility. The coming decade will likely bring larger and more frequent swings in markets, politics, and even social stability. Inflation, technological disruption, geopolitical competition, and environmental pressures will all interact in unpredictable ways. Those who rigidly cling to one ideology, one investment strategy, or one way of thinking will struggle. Those who can observe, learn, and pivot will endure. As in evolution, survival does not belong to the strongest or the smartest. It belongs to the most adaptable. At the individual level, adaptability means investing in skills and knowledge that remain valuable across changing environments. Technical skills will always matter, but so will creativity, emotional intelligence, and the ability to connect ideas across disciplines. As artificial intelligence and automation reshape the labor market, the ability to think independently, solve complex problems, and collaborate effectively will become the most sought-after assets. The most successful people will not be those who resist technological change, but those who learn to harness it. For investors, adaptability takes the form of diversification, not only across asset classes, but across time horizons, currencies, and regions. The biggest mistake investors make is overconcentration, putting too much faith in one asset, one country, or one currency because it has performed well in the past. History shows that no asset is safe forever. In the 1970s, inflation eroded the value of cash and bonds. In the early 2000s, equity bubbles wiped out fortunes. In recent years, even supposedly safe government debt has become volatile as interest rates and inflation expectations shift. A truly resilient portfolio is one that can withstand multiple scenarios: inflation, deflation, boom, and bust, because it does not depend on any single outcome. Diversification is not about maximizing returns in the short term. It's about minimizing the risk of ruin in the long term. The goal is to stay in the game. As Ray Dalio often says, if you're not diversified, you're taking on unnecessary risk without realizing it. A well-balanced portfolio, combining assets that behave differently under different conditions, provides stability when the world becomes unpredictable. In an environment like 2025, where inflation and interest rates fluctuate, geopolitical risks are rising, and markets are increasingly correlated, diversification is not a luxury. It's a necessity. At the national level, diversification means building an economy that is not overly dependent on one source of income, one trading partner, or one policy tool. Nations that rely too heavily on cheap debt, commodity exports, or foreign investment become vulnerable when those sources dry up. By contrast, Countries that invest in education, innovation, and productivity create a foundation for long-term resilience. They can adapt to global shocks because their strength comes from within, not from external dependencies. Understanding history is the third pillar of navigating this new era. History provides context for the challenges we face and a guide to how similar situations have played out before. The world has seen cycles of debt accumulation, monetary debasement, and geopolitical rivalry many times, from the Roman Empire to the Dutch and British eras to the rise and relative decline of American dominance today. Each cycle followed a similar pattern. A strong productivity and innovation lead to prosperity. Prosperity breeds excesses. Excesses lead to debt, inequality, and conflict, and those imbalances eventually force a restructuring. We are living through the late stage of one of those long-term cycles now. When you see these patterns clearly, you stop reacting emotionally to short-term events. Instead of panicking during downturns or chasing bubbles during booms, you begin to think in probabilities and cycles. You start to view market crashes, inflation, and even social upheaval as natural parts of a process, painful but necessary corrections that reset systems and create the foundation for new growth. The people and nations that understand this don't merely survive crises, they use them as opportunities to reposition and innovate. Adaptability also extends to how we think about money and value. The last century was defined by faith in paper currencies backed by governments. But as debt burdens grow and confidence in fiscal discipline erodes, we are seeing a gradual shift toward alternative stores of value, tangible assets, commodities, digital currencies, and other decentralized systems. Whether or not these alternatives will fully replace traditional money is uncertain. But their emergence reflects a deeper truth. Trust is the foundation of any financial system. As that trust evolves, so too must our understanding of what wealth really means. On a personal level, this period calls for balance, not just financial balance, but emotional and intellectual balance. It's easy to become fearful when the world feels unstable, but fear often leads to paralysis. The better approach is curiosity, asking, what can I learn from this? Or how have others adapted during similar transitions? The most resilient people are lifelong learners. They treat uncertainty not as a threat, but as a signal to grow. For societies, adaptability means encouraging collaboration over conflict. History shows that when inequality rises and trust declines, societies often fracture. But those that maintain dialogue, reform institutions, and share the benefits of progress endure far longer. In a world where polarization and nationalism are rising, adaptability will require empathy, the ability to understand other perspectives and work toward mutual benefit rather than zero-sum competition. Ultimately, navigating the changes of 2025 and beyond requires a mindset shift. We cannot control the cycles of debt, inflation, or geopolitical power, but we can control how we respond to them. The most successful individuals and nations will be those who anticipate change, prepare for it, and see opportunity where others see chaos. They will study history, diversify wisely, and remain flexible in both thought and action. The coming decade will challenge many of our assumptions about money, power, and progress, but it will also offer enormous potential for those who understand the rules of the game. Adaptability is not just a strategy, it is a survival mechanism. Diversification is not just financial, it is intellectual and emotional. And history is not just a record of the past, it is a roadmap for the future. Those who internalize these lessons will not only withstand the storm, but emerge from it stronger, wiser, and better equipped to shape whatever comes next. Every era in history has its defining moment, a point where the forces of economics, Politics and human behavior collide to create transformation. The world of 2025 is one such moment. The patterns we are living through today, excessive debt, persistent inflation, technological revolution, and shifting global power, are not isolated events. They are chapters in the same story that has repeated across civilizations. To navigate this period wisely, we must see reality clearly, embrace adaptability, and think in systems rather than snapshots. The fundamental truth is that economies, like people, go through life cycles. They are born, they grow, they mature, and eventually they face decline and renewal. What we're witnessing now is not the collapse of the global system, but its evolution. The old model, based on cheap credit, globalization, and single nation dominance, is giving way to a more complex, multipolar, and volatile structure. It is uncomfortable because transitions always are. But discomfort is the price of progress. Those who can understand and adapt to the new order will emerge stronger. Those who deny it will be left behind. We must recognize that debt and inflation are not abstract economic terms. They are reflections of human choices. When societies borrow beyond their means, when they prioritize short-term comfort over long-term sustainability, they inevitably reach a breaking point. Inflation, in this sense, is not just a monetary issue, but a moral one. It redistributes wealth, erodes trust, and challenges the stability of institutions. The way to counter it is not through panic, but through discipline, by building real productivity, saving prudently, and focusing on what creates lasting value. At the same time, the geopolitical realignment we're witnessing is reshaping the flow of money, ideas, and influence. The rise of multiple centers of power, from the United States and China to India, the Middle East, and Southeast Asia, is not something to fear. It's a natural progression in the global cycle. Just as the British Empire gave way to the American century, we are now entering a new stage where leadership is shared, competition is broader, and innovation comes from many directions. This redistribution of power can lead to conflict if mismanaged, or to balance if guided with wisdom. The choice lies with how nations behave and cooperate. For individuals, this moment calls for a new kind of intelligence, one that blends financial literacy with emotional resilience and historical awareness. It is no longer enough to rely on a single income source, a single country, or a single worldview. The world rewards those who diversify across assets, skills, and perspectives. Investing in knowledge, adaptability, and relationships will prove more valuable than chasing quick profits or political certainty. The goal is not to predict the next crisis, but to build a foundation that can withstand any crisis. We must also remember that the most powerful tool anyone can have in times of change is understanding. When you understand how the machine works, how money moves, how debt cycles unfold, how human behavior shapes markets, you stop being a victim of events and start becoming an observer of patterns. You gain perspective. You learn that downturns are not the end, but a reset, that inflation, conflict, and volatility are signals of transformation. History's greatest investors, leaders, and thinkers all share this mindset. They studied the cause and affect relationships that most people ignore, and they use them to make decisions based on principles, not emotions. The challenge of 2025 and beyond is not just financial but philosophical. We are being forced to confront what we truly value: security or freedom, consumption or sustainability, individual gain or collective progress. These are not easy choices, but they define civilizations. If we can learn from the mistakes of past cycles, from the empires that rose and fell, we can build a more stable, inclusive, and sustainable world order. But that requires humility, cooperation, and a willingness to adapt faster than the problems evolve. So as you look ahead, Don't ask whether the world is becoming better or worse. Ask how it is changing and what principles you can live by to stay aligned with those changes. The economy will continue to cycle. Markets will rise and fall. Empires will come and go. But those who understand the patterns, who study the past to interpret the present, will always find clarity in the chaos. The truth is, wealth stability and power are temporary, principles are permanent. The key to navigating today's economy and every economy to come is to stay humble, stay diversified, and stay educated. Don't react emotionally to what's happening. Respond intellectually. Recognize that what feels like disorder is often just the old giving way to the new. In the end, the greatest investment any of us can make is understanding reality as it is, not as we wish it to be. Because when you understand reality, you can align with it. And when you align with it, you can thrive no matter where the cycle takes you. The world is shifting, but with adaptability, perspective, and principle-driven decision-making, you can turn uncertainty into opportunity, just as every successful civilization, company, and individual has done throughout history. That is how you navigate today's economy, and that is how you build a lasting future in the world that is unfolding before us.